You know, when a person first steps into the trading world, they believe the market is a place where they can outsmart everyone else, pull a few clever moves, and walk away rich. But the market isn't a playground for trickery, nor a partner waiting to help you win. The market is a mirror, a perfectly neutral environment that reflects exactly what's inside you. If you approach it with illusions, expectations, or emotional baggage, it will expose them without mercy. It doesn't punish. It simply reveals. And most people only understand this truth after the market has forced them to look at themselves honestly, often at great cost. Tell me, have you ever felt that sharp sting? The kind that comes when you were sure you were right, but the market showed you something else. That's not the market mocking you. That's the market showing you your inability to accept uncertainty. Let me make it clear. There's one principle, one law above all others that protects your capital and your sanity if you allow it to. It's simple to understand, but difficult to embody because of human nature's attachment to being right. The principle is this: accept small losses quickly and without emotional resistance. That's it. You don't need a library of strategies. You don't need predictions. You just need the mental discipline to let go the instant the market tells you you're wrong. When a trade moves against you, close it. Don't hope. Don't justify. Don't argue with the chart. The market doesn't care about your opinions, your confidence, or your analysis. It doesn't even know you exist. It only expresses behavior, probabilities unfolding in real time. Those probabilities will play out regardless of what you think. Every trader begins believing they're smarter than the market. But how many times have you watched a losing position, convinced it would come back? Did it? Or did you sit frozen while a manageable loss grew into something unbearable? That's what happens when we refuse to accept small losses. We create large psychological ones. The trader who resists the pain of being wrong will one day face the pain of being ruined. I learned that the hard way, again and again. Early on, I made and lost fortunes because I broke my own mental rules. The charts showed me I was wrong, but my ego whispered I was right. Guess which voice I listened to? The wrong one. And I paid for it. Because in trading, you're never beaten by the market. You're beaten by your own inability to accept feedback from it. The market doesn't destroy you, it only reflects your inner conflict. Think about this. If you touch a hot stove, you pull your hand away instantly. You don't argue with the heat, hoping it cools down. Yet when it comes to losing trades, traders hold on. They let their emotional hand burn because they can't admit they're wrong. By the time they act, they've lost more than they can emotionally afford. Isn't that madness? And yet it's the most common human pattern in trading. The difference between a struggling trader and a consistent one isn't knowledge. Anyone can read a chart. The difference is mindset. The professional accepts risk, acts without hesitation, and never personalizes the outcome. The amateur hesitates, hopes, and suffers. Trading must be treated as a mental discipline, a game of probabilities, not certainties. A good general doesn't fight unwinnable battles. He withdraws, preserves his resources, and waits for better conditions. Why shouldn't you do the same with your capital and energy? Someone once asked me, "Mark, how do you know when to cut your losses?" And I said, "The moment the market proves your hypothesis invalid. Not tomorrow, not next week, immediately. Because if you hesitate, you've replaced objectivity with emotion. Hope belongs in faith. It has no place in trading. Understand this. The best traders in history aren't those who made the most brilliant predictions. They're the ones who mastered self-control. who accepted that losses are simply the cost of doing business in an uncertain environment. Consistency isn't about being right, it's about managing being wrong. A trader who takes small losses will always have another opportunity because his capital and his confidence remain intact. But the trader who lets losses expand eventually loses both. Do you see now why this principle is everything? You don't need the perfect system, the perfect entry, or secret information. You need the self-awareness to say, I was wrong, and the discipline to act without hesitation. How many times have you ignored that inner whisper, the one that told you to exit, only to regret it later? Most traders equate losing a trade with losing their identity. They take market feedback personally, as if being wrong means being lesser. But trading has nothing to do with self-worth. It's not a moral test, it's a probability game. The market doesn't care about your ego, only whether you can stay psychologically balanced when it proves you wrong. If a position moves against you, that's objective information. It's not judgment, it's feedback. The faster you accept it, the more aligned you are with reality. Now, I don't mean jump out of every trade the second it fluctuates. That's fear, not discipline. I mean defining your risk before you enter the trade, knowing exactly what invalidates your idea and committing to act when that happens. Draw the line in your mind. When price crosses it, you're done. That's not weakness. That's strength. That's self-trust. Survival comes before profits. When I traded short-term, I saw this truth daily. I'd enter a position, it would turn against me, and the old instinct would whisper, hold on, it'll bounce. But I remembered. Every moment of hesitation is a test of self-control. So I'd close it, take the small hit, and reset. A few minutes later, the stock would collapse, and I'd be reminded, acting fast preserves mental clarity. Still, I wasn't perfect. Even with years of experience, I'd fall back into the trap of believing this time is different. Each time I did, the market reminded me otherwise. The worst losses I ever experienced didn't come from lack of skill. They came from emotional attachment, from thinking I could control something inherently uncertain. And that's the core lesson. The market doesn't punish mistakes. It punishes resistance to reality. The moment you argue with the chart, you've already surrendered your objectivity. Because while you're rationalizing, the market keeps moving. Remember this. The one rule that could save your capital, your confidence, and your career is simple. Never let a small loss become a big one. Simple, but psychologically demanding. Harder than identifying trends or reading charts, because it requires mastery over your own mind. If you can't manage yourself, you can't manage risk. Cutting losses fast is not about protecting money. It's about protecting your mindset. Those three words, cut your losses, are the true foundation of consistency. They sound simple, but they represent the highest level of trading psychology. Detachment, letting go, acting without hesitation when reality shifts. It's not easy. It never will be. But it's the difference between the trader who survives and the one who is consumed by his need to be right. Have you ever sat in a losing position, watching it slip, convincing yourself it'll come back? And didn't it slip further until you were no longer trading but hoping? Hope is the mind's last defense against admitting uncertainty. But markets don't forgive hesitation. The tape doesn't care how you feel. You must train yourself to respond instantly to feedback, not emotionally, but mechanically. Even then, you'll relapse. You'll forget. You'll believe again that you know. And the market will remind you that all we ever truly have are probabilities. That's all trading is. Learning to act in the face of uncertainty. Most traders accept the idea of letting profits run, but resist cutting losses because they fear being wrong. But small losses are the tuition you pay for clarity. Refusing to take them is like refusing to pay insurance on your capital. So ask yourself, do you have the courage to take those small losses over and over to stay aligned with the reality? The undisciplined trader is like a gambler who can't fold a bad hand. He keeps playing, hoping to see the next card, chasing a feeling of being right. But the disciplined trader folds instantly, conserving energy for the next setup. Because in trading, folding isn't weakness, it's survival. I've seen countless traders fail, not from ignorance, but from denial. They couldn't take a loss. They confused being wrong on a trade with being wrong as a person. And the market has no mercy for that confusion. A trader can be wrong many times and still succeed, if he acts quickly. But one big uncut loss can erase everything. Speed is key. Don't give your losses time to grow roots. The market doesn't pause while you rationalize. It moves, and every second of hesitation costs clarity and capital. You must train yourself to act like a soldier following an order, instantly, without argument. Imagine what would happen if every soldier debated before moving. Chaos. That's what happens to your trading account when you hesitate. Cutting losses doesn't make you weak. It makes you free. It means you've mastered the hardest battle of all, the battle within yourself. A quick loss clears your mental space. A lingering one consumes it. It ties you to the past, to a trade that's already invalid. Have you ever been glued to a losing position, watching it drain your focus, while new opportunities passed you by? That's the real cost of not cutting losses. Not just money, but mental bandwidth. That's the real cost of not cutting quickly. It's not just the money. It's the mental and emotional cost of being chained to a belief that no longer serves you. When you hold on to a losing trade, you're not just stuck in a bad position. You're attached to a dead idea, a false certainty. You're locked to the past while the market moves freely into the future. I used to remind myself of one thing. The market doesn't know you exist. It doesn't know you own that stock, that contract, or that position. It doesn't care. It's neutral energy, moving according to probabilities. Yet most traders project meaning onto it, as if the market somehow owes them an outcome because of the effort or conviction they've invested. But the truth is, the market owes you nothing. The moment you assume it does, you've given up your control over yourself. Cutting a loss quickly isn't an act of defeat. It's an act of self-alignment. It's how you protect yourself from illusion. It's how you acknowledge that the market is bigger than any opinion, and that your job is not to control it, but to align with it. That isn't weakness. That's awareness. And awareness is the rarest form of strength in this business. Think of it this way. A surgeon doesn't ignore infection, hoping it will disappear. He doesn't pray the wound will heal while the poison spreads. He acts immediately, because he understands that inaction is fatal. Your trading account is no different. A bad position is an emotional infection. The longer you let it linger, the deeper it spreads into your judgment, clouding your perception until you can't see the market objectively. Most traders wait. They rationalize. They tell themselves it will turn. And by the time they act, the damage is irreversible. How many times have you done the same, trying to nurse a trade back to health instead of accepting that it's dead? It's no different in trading than it is in medicine. A trader who can't cut a loss is already diseased with attachment. And without capital, he's no longer a trader. He's a spectator looking back on what he could have done differently if only he had accepted reality in time. The question is simple, but defining. Do you want to be the trader who survives and adapts, or the one who clings to what should have been? Every trade presents the same choice. Act on feedback or defend your beliefs. Cut or cling. The irony is, once you master cutting losses, you stop fearing them. You stop needing to be right. You stop begging the market for mercy. You understand that a loss doesn't mean failure. It means feedback. You start to trade from a place of calm, clarity, and confidence because you no longer personalize the outcome. You know that no single trade defines you, and no single loss can destroy you if you've respected your boundaries. That mindset, the emotional neutrality that comes from true acceptance, is what opens the door to consistency. Because make no mistake, the only path to big profits runs through small losses. Every consistent trader who's ever built a fortune did so not by avoiding losses, but by controlling them. The greats all lost money, but never themselves. They cut quickly, accepted feedback, and moved on while others froze. The amateurs, on the other hand, couldn't let go. They held, they hoped, and they drowned under the weight of their own expectations. Don't be the trader who trades to prove something. Be the one who trades to stay aligned with the market's truth. And now ask yourself honestly, are you willing to act without hesitation when the market proves you wrong? Or are you still hoping that your certainty will somehow bend reality in your favor? Because I can assure you, it won't. The market doesn't punish mistakes. It punishes resistance to truth. Survival always comes before profit. Capital preservation is not just a financial rule, it's a psychological foundation. Without capitals, you're not a trader. You're just a spectator of opportunity. With capital, you have flexibility, freedom, and time. Time to adapt, to learn, to evolve. Once you lose it, no amount of analysis or confidence can bring it back. So ask yourself, what good is the perfect setup if you have no emotional or financial capital left to take it? Most traders enter the market obsessed with potential gains. They dream of windfalls, of doubling their accounts, of instant success. They're fixated on reward, blind to risk, and that blindness turns them into gamblers. They overtrade, overleverage, and overcommit. They chase profits without realizing that in doing so, they're trading not the market, but their need for validation. A trader who thinks about profits first will always gamble, because his motivation comes from fear and greed, not discipline. The trader who thinks of survival first, who sees risk as the price of staying in the game, approaches each position as a professional. He treats capital like a soldier treats ammunition, not something to be wasted, but something to be used with precision. That mindset doesn't just preserve accounts, it preserves emotional energy. And it's that energy that sustains you through the cycles of uncertainty. Doesn't that sound like common sense? Yet so few live it. I've seen brilliant people lose everything, not because they lacked intelligence, but because they believed intelligence alone could control randomness. They confused knowledge with certainty, and the market punished them for it. I've also seen quiet, disciplined traders who never tried to predict, who never risked everything on one idea, build enduring wealth simply because they stayed alive long enough for probability to work in their favor. So which one would you rather be? The trader who burns bright and fades fast, or the one who endures, adapting through every storm? Because in truth, the market is not a contest of brilliance. It's a test of endurance. It's not the cleverest or boldest who win, but the most psychologically balanced. Every trader, no matter how skilled, will take losses. That's not failure. It's participation. But only the trader who respects his capital, who never risks emotional or financial ruin on a single outcome, will survive to recover. A trader who overbets is like a soldier who charges without reserves. If he wins, he looks like a hero. If he loses, he's finished. Ask yourself, would you rather depend on luck or on discipline? Capital is not just money. It's your trading oxygen. It's your ability to act, to adapt, to continue. A carpenter needs his tools. A trader needs his stake. Lose it, and your opportunity to participate disappears. Protect it, and you retain the power to choose. That's why survival isn't secondary to profit. It's the source of it. Profit is the byproduct of staying alive long enough for probabilities to favor you. A dead trader can't trade. A broke trader can't recover. I've seen many who were brilliant for a season vanish when conditions change because they had no capital left, financial or psychological, to endure the shift. Survival means more than cutting losses. It means managing exposure. It means never placing yourself in a position where one trade can destroy you. Too many traders want to make a killing. They crave intensity over consistency. They bet too big, too often, and call it courage. But that isn't speculation. It's self-destruction disguised as confidence. A professional understands that certainty is an illusion. The moment you feel untouchable, you're already at risk. Think about your biggest losses. They probably came from the trades you were most convinced about. That's because conviction without flexibility breeds blindness. Capital preservation means not only managing loss, but knowing when not to engage. Sometimes the market is too erratic, too emotional, too uncertain. The amateur needs constant action. The professional values clarity. He waits. He protects his capital and his mind until probability tilts back in his favor. Doing nothing is sometimes the most powerful decision a trader can make. In markets, restraint is a position. Money not lost is capital preserved. And in this game, preservation is everything. There's wisdom in stepping aside when probabilities aren't clear. Can you recall the times you chose not to trade, only to see later how much emotional and financial pain you avoided? That was psychological discipline in motion, and it saved your capital, just as surely as any profitable trade ever could. Remember the old saying, keep your powder dry. It came from the battlefield, soldiers saving ammunition for when the shot truly mattered. The same truth applies in trading. Your capital is your ammunition. Waste it on impulsive trades, on tips, on random guesses, and you'll have nothing left when the high probability setups appear. A trader without capital, whether financial or emotional, becomes a spectator in the game he once played. Haven't you ever found yourself flat broke in both money and confidence, watching the big move you'd been waiting for unfold without you? That's the cost of thinking about profit before survival. Survival keeps your mind steady. When your capital is protected, your perception remains clear. You think in probabilities, not in hopes. You act rationally, not reactively. But when you're overexposed, when every tick feels like life or death, your psychology collapses. Every fluctuation becomes personal. You can't think clearly, can't act decisively, and can't honor your own rules. Protecting capital isn't just about the account balance. It's about protecting your state of mind. A calm mind is a strategic mind. A desperate mind is a self-destructive one. Isn't mental clarity worth more than emotional thrill? Traders often ask, how do I grow my account? The answer is deceptively simple: by not losing it. Growth is the byproduct of longevity. You can't capture the big trend if you've emotionally or financially blown up before it arrives. Profit isn't something you chase. It's something that emerges naturally when you've survived long enough to align with the right opportunity. Survival first, profit second. That hierarchy never changes. Ignore it, and you'll learn through loss. Let's simplify this. Would you rather make $10,000 this month and lose it all the next, or earn smaller, consistent gains over years while preserving your freedom to trade? Most people pick the quick money, their minds wired by greed and impatience. But the trader who values stability over excitement, who prioritizes staying in the game, becomes the one still standing after the others have fallen away. Wealth isn't built in moments of brilliance. It's built through endurance. Survival also requires humility. It means acknowledging that the market is always bigger than you, that uncertainty never leaves the equation. The trader obsessed with profits becomes proud and careless. The trader focused on survival becomes cautious and aware. Which attitude do you think the market rewards? Every time you feel invincible, the market will find a way to remind you you're not. The public loves stories of big winners, the overnight millionaires, but those stories omit the countless others who went broke chasing them. The true masters are rarely celebrated because they trade quietly, protecting capital through every storm. They may never make headlines, but they outlast them. That's the power of survival. Protecting your capital is the foundation, the cornerstone of trading psychology. It's the truth beneath all systems and methods. You must stay in the game to win the game, and that requires one thing above all: discipline. Discipline separates the consistent trader from the emotional one. It's not intelligence, luck, or even knowledge that draws the line. It's self-control. Every person can read charts, follow the news, or learn the mechanics, but few can act consistently in the face of uncertainty. The market isn't a puzzle to be solved. It's a mirror reflecting how well you manage yourself. The ones who survive aren't the smartest. They're the ones who can remain centered while uncertainty rages around them. Think back. How many times did you know the right move but failed to take it? The amateur believes the edge lies in prediction, in spotting something others don't. He's always chasing shortcuts and secrets. The professional knows the only true edge is discipline. When the chart says get out, he exits, not because it feels good, but because it's what his process demands. When the market is trending, he holds, despite the discomfort. Meanwhile, the amateur lets fear and greed push him around like a small boat in a storm. The professional moves with the current, not against it. Discipline means doing what your rules require, not what your emotions suggest. Feelings have destroyed more traders than any bad strategy ever did. Hope makes you hold losers. Fear makes you sell winners. Greed makes you overtrade. And pride keeps you from learning. The disciplined trader doesn't trust emotion, he trusts structure. He builds systems and trains himself to follow them under pressure. So what's harder, knowing the rule or obeying it? Most traders already know what they should have done after the fact. But trading is not about hindsight, it's about execution. The market constantly tempts you to break your own boundaries. It whispers, hold just a little longer. It seduces you with quick profits and false comfort. And if you lack discipline, you'll listen, because it's always easier to follow impulse than to follow plan. But the market forgives nothing. Every lapse costs you something, if not capital, then confidence. Remember a time when you broke your own rule and paid the price. Didn't it hurt more because you knew better? The professional sets his rules in advance. Entry, exit, risk. He defines his decisions before emotion ever enters the equation. Then he follows through without hesitation. The amateur decides in the moment, reacting, adjusting, hoping. That's why he's always at the mercy of the market instead of being aligned with it. A man without discipline drifts like a leaf in the wind. A man with discipline stands firm like a tree, flexible but unbreakable. Which one are you when the market turns rough? Discipline is also patience. It's the ability to wait until probability and opportunity converge. Amateurs crave constant action. They equate activity with progress. They fear missing out more than they fear being wrong. Professionals know that most of the time, the right move is to wait. The big opportunities don't come every day, and without patience, you waste your capital on noise. Haven't you ever fired too soon, only to realize the real move came later, when you were already spent? Another face of discipline is courage, not recklessness, but the calm strength to follow your rules even when it hurts. It hurts to cut a loss. It hurts to stay out when others boast of wins. It hurts to hold through discomfort while your mind screams for instant relief. But the professional understands that short-term discomfort is the price of long-term survival. The amateur avoids pain and pays for it later. The professional embraces it and earns peace. I've seen traders with every advantage, capital, connections, inside access, lose everything because they lack discipline. And I've seen traders with small accounts, no privileges, and no secrets build steady fortunes because they mastered themselves. This business doesn't reward brilliance. It rewards self-mastery. The market finds your weakness at greed, fear, pride, and exposes it. Only discipline keeps you safe. Look at the market tape. It has no emotion, no bias, no pride. It simply moves. The amateur reacts to every twitch. The professional observes and waits. The difference isn't intellect, it's control. That's why amateurs live in anxiety while professionals operate from calm. Anxiety is the symptom of lacking control, and control begins with discipline. You want peace of mind in trading? Then cultivate consistency. Because discipline is the only source of peace the market respects. Discipline is consistency in action. Anyone can be disciplined for a day or a week. The market tests you every day, every trade, every emotion. Can you stay aligned with your process, not once, but 10,000 times? The amateur treats discipline as a mood. The professional lives it as a habit. The amateur obeys when it's convenient. The professional obeys especially when it's uncomfortable. Which one do you want to be? Every time you break a rule, even if you get away with it, you weaken yourself. You teach your subconscious that discipline is optional. And one day, that small crack becomes collapse. Every time you obey, even if it costs you, you strengthen your foundation. You build reflex, confidence, and trust in your own process. That's the real edge, the ability to act consistently regardless of outcome. The market will always be uncertain. That will never change. But your behavior can be certain. The amateur believes certainty lies in predicting price. The professional knows certainty exists only in discipline. You can't control the market. You can only control yourself. And in that, self-control lies the only sustainable edge you'll ever have.